Trivariate's Adam Parker's with us here at Post 9. Talk about this and a lot more, Adam. It's good to see you.
Hey, everyone.
Do you think the market got some kind of religion yesterday?
You know, I was listening to you guys there. The dots are stupid and the lags. And, like, I think it's just always hard to know what data point's going to matter when, right? I mean, you listen to Santoli say there's 17 consecutive data points of a down LEI, and the stock market's basically ripped for the last 12 months. So I don't know if we need to use that data point as a predictive algo anytime soon. The dots, we all knew that there were too many cuts in the price for the last 6 or 9 months, right? I mean, I don't know. He was hawkish, but has he said anything dovish ever this cycle? So, like, you know, sometimes you just don't know when people are going to react. You know, I did a bunch of meetings in the Midwest and in New York the last 2 days, and I think the number one question I get is about the same market breadth question. Like, what do I do with the big seven? Like, how do I sort of triangulate around my exposure to Google, Apple, you know, Microsoft, et cetera, and what's the case for maybe a broadening out? You know, some M&A is a good sign. That usually means there's some activity and value. So I think the case comes down to margins expanding for more companies, and I don't think that's that likely. So I think the market goes higher and the big seven do well. Relatively. So I don't think we're going to get a big broadening rally that everyone's calling for. A lot of people, can I buy small caps because they look cheap?
Why not?
I think you need to believe their estimates are more achievable, their margins are going to expand more. Look at what the big seven are reporting. I mean, I don't think they're reporting relatively disappointing numbers. I mean, so when I look across, I mean, I don't know, maybe Microsoft's going to take longer to get their stuff working. I don't know, maybe Google probably has some stuff that could be better than people think. NVIDIA, you want to bet against their numbers next. You know, so you look across the big ones. I don't think you want to say they're relatively worse than everyone else. The case for broadening is probably labor costs come down a lot. You just went through that algorithm. I don't think labor looks like it's particularly weak. Materials are up from the bottom. They've come down, but they're up. So I don't know if that headwind to tailwind's going to be that awesome for those companies. So I think, you know, my observation would be breadth is not that likely. The second thing I'd say from these recent meetings is I don't know one person who was like, I looked at equities versus bonds at the beginning of this year. I decided equity risk premium is garbage. I was way overweight U.S. equities, and I owned a ton of NVIDIA. Okay, so I think the point is people are going to chase, all right? Most people's numbers are not where they should be relative to when you just type in the S&P, you type in the Qs. And so I think we have some flows coming in a rally to year end. And maybe it's like last year where Jan 3rd, first, second, day of the year, it just all reverses again and people are trying to figure out what worked this year that they sell. I mean, that's kind of where it feels to me from the 10, 12 meetings I did in the last couple of days.
Well, is the upcoming earnings season going to be encouraging? Because you look at consensus, it doesn't sound that great.
You know, there's been 2 or 3 major bulge bracket firm conferences and industrials and healthcare, and you look at the data coming out of those and you talk to people and you read what the companies say. We do it all, systematically. I think generally mixed to slightly positive is the news for this quarter. I didn't see any, maybe Eaton saying their backlog plateaued. I mean, there's a couple of data points where we know things are slowing, but I think you got to be worried about companies like that have very high inventory and are expensive. But across the economically sensitive data points, I didn't see much. And then the other thing that I think we always get torn is the S&P 500 is not the economy. The S&P 500 is a list of awesome companies that are like the best of the economy, right? So you don't necessarily going to have earnings collapse, and I think that's what we all get kind of torn with. So sure, we're going to react once in a while when they're hawkish, but I think this is part of that Goldilocks of transitioning to lower growth, and I don't think the Fed's going to ruin any of the economic stuff anytime soon.